Hi guys, Boris Dorfman here with LBC Capital Income Fund. I want to talk to you quickly about interest rates, Fed decision, inflation, and why Fed keeps raising rates. Is it really necessary? Because there's mixed signals. Inflation is coming down. Make no mistake about it. Inflation is coming down, and Fed is raising their interest rates. So what's going to happen with interest rates with the real estate market? Let me break it down for you. One, it looks like Fed is extremely political. I mean, there's economic decisions, but there is political decisions. There is election next year. I don't know what the hell they're doing, but it does sound a lot more like politics to me. And if I'm a betting man, I'll tell you we're not going into a recession in the election year. That's really take it to the bank. We're not going to go into the recession until the election. So it tells me that sometimes in the next 6 to 9 months, the Fed will not just level off. They will start reducing the interest rate at their meetings. So what is inflation? We spoke about it many times, but inflation is measured by Consumer Price Index, CPI, and PCE, Personal Consumption Expenditure. And there's two, within each reading, there's two ways to measure it. There is a headline number if you take all basket of goods, and there is a core number. Core number excludes volatile items like food and energy, items that we really cannot control. There is a monopoly on the oil, OPEC meets, they cut production, oil goes up, our inflation goes up, and food is very sensitive to energy prices, so food goes up. So core number excludes the food, and energy, but the people really feel nominal numbers. When Fed started hiking rates, they said, well, we're going to watch the inflation, want to get it down to 2%. Everybody assumed that we're talking about a headline number that includes everything, right? And Fed also hinted that people's wallet feels the inflation. So people feel it when they fill up their cars and oil is higher, or when oil drops, they feel it in a positive way. Later, the Fed changed the tune and they're saying, well, we're going to look at the core number, right? So oil came down, food prices came down, there's no shortages, you can go buy eggs, you don't have to pay $12 for a gallon of milk anymore, things like that. So that inflation came down, and there's a lot more things in CPI and PCE for that. So inflation peaked around 9% and it dropped to around 3% on PCE and CPI for June's reading, right? This month. But the core inflation has been sticky. So core inflation was never that high. I forgot what it peaked at, but it's slowly coming down. So core inflation is around 4%, right? It's been coming down. The path is there. The trajectory is there. It hasn't been coming down as fast as Fed would like to see. And really, Fed wants to err on the conservative side. Again, they're driven by politics. I have no clue why, but really they're afraid that inflation may come back. And it may be a valid concern because there was $11 trillion printed. I thought we're going to see a recession. I don't think so. When you go out, you go to the restaurants, every expensive, non-expensive, every restaurant is full, right? You cannot make reservations for Thursday, Friday, or Saturday into a restaurant in Beverly Hills, in Vegas. God, go to Vegas. Hotels are obnoxiously priced and they're all full. People are vacationing, people are spending money, restaurants, Disneylands. I went to the zoo, it was full. People are out there spending money. 2008, real estate crash, people were afraid, people were sitting home, they were not spending money, economy went into the recession. I don't think we're going to see a recession in the next year, within the next 12 months, unless Fed starts overshooting again. But I do think Fed will start easing in the next 6 to 9 months. Also, within these CPI numbers, some bigger component, the biggest component is rent. They call it shelter. The biggest component is rent, and it's a lagging indicator. They do average over the past 12 months. So if somebody signed the lease a year ago or 11 months, they average, right? So rents are rising still, but the rents are not rising as fast as before. So CPI is the change. It doesn't have to drop, but it has to grow. Fed is looking for 2%, right, on the core numbers. So there is lagging data as far as car sales. It's cars and used car sales, the prices dropped significantly. People are not buying cars for one reason or another. One of it is high interest rates as fast as before, and the prices have came down. Also, the rents are still appreciating, but they're not appreciating 10-20% a year like they did before. And this data within CPI and PCE, it's lagging significantly. So over the next few months, we're gonna see more positive inflation data. I think that Fed has stopped raising interest rate. They're not gonna raise anymore, my opinion. Market's still waiting for another 0.25% hike. And the minute inflation really, next 5-6 months, I think Fed is really going to start thinking of taming the inflation, lowering the interest, taming the interest rate, lowering the interest rates. And it's all positive for real estate. Rates are going to drop. I'm not a cheerleader here, but with no inventory and potential for lower interest rate, I don't think we're going to see lower property prices, at least on residential, single-family, multifamily buildings in the next 18 months. Take it to the bank, guys. If you're not subscribed yet, please do so. I'll see you next time. Thank you.